Hello and welcome to your monthly investor update. My name is George Santaralala and I'm the Growth Marketing Manager here at Nutmeg. If you've been watching our recent updates, you'll know that we are following the government guidance around social distancing and working remotely. Therefore, rather than filming in our headquarters in Vauxhall, we're filming this today over Zoom. So today I'm joined by our Director of Investment Strategy, Brad Holland. Hi, Brad.
Hi, George.
So after rallying strongly in April and May, financial markets were a lot more up and down in June. I'm assuming this was mainly down to news about coronavirus and concern over new cases. Is that correct?
Well, yes and no. Markets were up and down. That would be an understatement. There was an 8% range in the main US index in June, with it finally finishing up 2%. The UK FTSE 100 index, that was a little less volatile, not much, but it ended up 1.7%. Bond markets also shared this roller coaster behavior. Now, however, the volatility was not primarily about coronavirus. The big initial rally in the start of June followed the hugely impressive 2.5 million employment bounce for the US economy in May. That was a wake-up call for market participants getting overly bearish about the global economy. Asia had already been showing signs of a rebound since it was first to come out of lockdown. However, coronavirus did have some impact. With second-round virus infections being reported, some began to question the recent positive run on equities. And even after another spectacular June US employment figure, this time 4.8 million increase in employment, US employment remains 14 million. That's 10% below the February peak.
Right, so I guess that explains why there's still a lot of talk about recession. Some commentators are saying that they expect the UK to be one of the worst hit countries for the recession. Are you concerned about it?
We have already been in recession in the UK and everywhere else for that matter. The enforced shutdown was like turning the lights out on major parts of the economy. The UK is no different to any other country in that respect. Certainly the UK policy response in order to get the UK economy back on track has been very impressive. So there is no need to think of the UK as a weak link in that respect. There is a widely reported view that COVID infections are worse in the UK compared to other affected countries, and that this would restrict UK economic growth. But these statistics are not directly comparable from one country to the next. Certainly until we have better data on how widespread COVID really is across global populations, there's no reason to think the UK should perform any worse than other major economies in the recovery phase. Now, where of course the UK can be singled out is on its trading relationships. The final form of its trading relationship with the EU next year is still up for grabs. And a reasonable expectation would be that the UK activity would be adversely affected on a no-deal scenario.
So is there anything that investors can do to reduce their recession risk? And also, aside from the coronavirus, what other big stories are impacting the financial markets right now?
Well, you rightly ask if there is anything investors can do about recession risk. And the answer is yes, that they can pay very close attention to what policymakers are doing. So far, they have adopted a whatever it takes attitude towards minimizing the long-term economic damage of the shutdown. And that means stimulus. If things take a turn for the worse, expect more stimulus. And this seems to be what the market has come to realize. First, that any future virus lockdowns will be more localized than what we have seen so far this year, so therefore less disruptive. And second, that the policymakers are on the case. And who pays for all this stimulus? Well, of course, we all do in the long term, but that is not a major consideration in the near term. And that brings me to the second part of your question. What other near-term events should we focus on? Well, the US election could bring a significant change in style of US policy, particularly in China relations. A major question has to be if the Democrats win the White House, whether they would seek to unwind the corporate tax cuts that were put in place by President Trump. Well, that would be a big negative for equities. However, given the reliance on companies to rehire so many unemployed workers, or do you think the Democrats may decide to go softly on corporate America? And how will the potential new administration change the current US-China trade negotiation dynamics? Well, we'll have to wait and see. But while on the topic of trade, I can't finish without mentioning Brexit. What will the UK's trade relationship look like next year? Well, the end of July seems to be an important deadline for the UK government to get it sorted. October seems a more important deadline for the EU. Either way, we expect a lot of news to flow over the next month or two. And Nutmeg retains a cautious stance in its fully managed portfolios.
So sounds like a lot to keep our eyes on over the coming months. But looking back, how did the Nutmeg fully managed portfolios perform in June?
Well, fully managed portfolios rose between 1% in lower risk portfolios up to just under 3% in the higher risk portfolios. So with a strong equity market in the second quarter, half of our fully managed portfolios are now flat or positive in their year-to-date returns.
And in this complex environment, have you made any changes to the fully managed portfolios?
Yes, we trimmed some of our US equity overweight into Japanese equities, and we swapped some European equity exposure into a socially responsible European equivalent. We also swapped some US corporate bonds into higher yielding US bonds.
Thanks, Brad. So now this month's customer question comes from a reader called Patrick on our Nutmegonomics blog. Patrick asks, I noticed that over half of my Nutmeg pension pot is invested in the US. I appreciate that the S&P 500 has performed really well recently, thanks largely to the growth of big tech firms. But doesn't the lack of geographical diversity leave us exposed in the event of another tech crash? Brad?
Well, thank you for your question, Patrick. The US exposure of our portfolios will vary depending on the investment style and the level of risk you have chosen. Broadly speaking, in higher risk portfolios, US exposure will come mainly via US equities and some small amount of US fixed income. In socially responsible investments, which I believe is where you are invested, we have higher US allocation because the socially responsible space is not yet as fully developed as regular index investing. So in these portfolios, more fixed income exposure is currently US based rather than UK based. The higher risk SRI portfolios have between 34 and 46% US equity exposure, along with US fixed income exposure between 10 and 20%. So US exposure is not equities alone. That's why you'll see over 50% in your portfolio. Still though, this compares to the regular MSCI World Equity Index, where the US comprises over 60%. Now turning to your point on technology companies, we do not place a high probability on a tech crash and see this sector as forging the new automated and connected economy. While valuations in the tech sector have attracted some attention, return on equity remains high. And with recurring revenues increasing and strong balance sheets, we still maintain the tech-heavy US bias for now. For our fully managed and socially responsible portfolios, we're managing the US equity exposure carefully, and should our risk assessment change, we will adapt.
Thanks, Brad.
Thanks, George.
And thank you for joining us. We know that it's a very difficult time right now, and we understand that lots of our customers have questions for us. So we'd really encourage you to please feel free to get in touch with us, either via email, by social media, or in the comments section below. We will do our best to get back to your query. In the meantime, though, best wishes to you, your family, your colleagues, and your friends. And we look forward to seeing you on the next monthly update. Thank you.